Hello my fellow investors and welcome back to another stock analysis video. And today guys, let's take a look at the company Lincoln Financial Group, which is brought up by Tony. We're almost done with these recommendations guys. Here we go. And actually pretty good at the nick of time too, because I believe next week is when banks start having their earnings. So that should be very, very fun to see. So we'll see how that goes. Nonetheless though, we're gonna take a look at the company LNC, brought up by Tony. And again, that is this company, Lincoln Financial Group. So with that said, let's get started with this analysis. So now taking a look over here at the profile, because I have no idea what this company does. We see that they are in the financial sector, life and health insurance. So the fact that they're in the financial sector, guys, is already a, well, I wouldn't say a big red flag, but with the things that have been happening recently, they might get affected even though they may not be a bank. Nonetheless though, Lincoln National Corporation, through its subsidiaries, operates multiple insurance and retirement businesses in the United States. This is sounding very, very similar already to Jackson, as you guys saw. But I already took a look at the fundamentals, guys, and yeah, no, ooh, that's actually not as impressive as I would think. Nonetheless though, we'll take a look at that later on. It operates through four segments: life insurance, annuities, group protection, and retirement plan services. The company's life insurance segment provides life insurance products including term insurance, such as single and survivorship version of universal life insurance, variable universal life insurance, index and universal life insurance products, and critical illness and long-term care riders. So yeah, then they just go on to say like what the other ones do. Nonetheless, so I think we pretty much got a gist of this. Yeah, they provide insurance, guys. They provide life and health insurance, as you guys see here, by the industry. And also something interesting as well, their found date was in 1905. So more than 100 years this company has been operational. Very, very nice to see. And now taking a look at their earnings, they had this guys on the 8th of February and it was not good. EPS normalized actual came in at 97 cents, missed by 81 cents. EPS gap actual 1 penny, missed by $1.67. That's a lot. Revenue actual $4.68 billion, which is beat by $99.88 million. And we can see over here that their next estimated earnings, it is for May 9th, 2023. So now let's jump into the calculator, more specifically the book value per share, because financial sector guys, usually they don't have a lot. Well, actually, in general, they don't have cash from operations or capital expenditures, so we have to use book value instead. So we got the ticker symbol for LNC, market cap of $3.65 billion and a PE of NA. Yeah, they have negative net income, which is the reason why this is the case. Like if we put any other company, for example, if we were to put JP Morgan, we could see that the calculator is actually working. However, when it comes to this one, it's still an A because again, their net income, unfortunately, it isn't a negative. But again, it's a little bit weird. So we're going to take a look at that in just 1 second. The current share price is $21.59. Which in the 1 year, guys, they are down. Oh, man, what a number. They are down negative 66.66%. And year to date, they're also down almost 30%. You can see that they definitely peaked over here at around like February. Yeah, around like February 2nd, I would say. And they peaked there at around like $36.10. But ever since then, guys, it has just been a downhill disaster for them. And the banks going under probably did not help either. I mean, that happened at around like the beginning of March, and right over here, this is where we see the drop off right there on March 3rd. Boom, we just see the drop off. 52-week range, it is $19.74 to almost $70. So this is a 52-week low company. This will be very, very interesting to see if, depending on book value and changeable book value, this is telling us that this is a buy today. Now they do pay out a dividend of $1.80, and yes, I did change this from 20 cents. For anybody who caught that, I forgot to change it. My bad, guys. But yeah, they do pay out a dividend of $1.80, which, guys, is oh man, it's a yield of 8.05%. This is going to be a massive annual dividends when we get to that part of the video. Like when we do the whole, if you put in this much, this is how much you will get back. So very, very interesting, guys. This is a payout ratio, however, take a look at this payout ratio, negative 33.52. So anything above 100, guys, they're taking on debt. I'm not so certain. I would have to think about what the negative would imply. I'm pretty sure, like, if I were to just think about it for like a minute, I could figure it out. But yeah, negative 33.52, that's a little bit concerning. a 5-year CAGR of 8.45%, which is 12 consecutive years in dividends, guys. That's very, very interesting to say the least. That's a lot of years paying out this dividend consecutively. Ex-dividend date passed. Actually, no. Oh, yeah. I am so sorry. By the time you guys are seeing this, you will have... Well, I don't know. You know what? I'm actually going to post this a little bit earlier just in case anybody wants the ex-dividend date and I don't mess all of you guys up. Because if I post this video at 4 o'clock, the market will be closed. And the ex-dividend date here is, well, April 6th. So, you know, by the time you guys see this will be April 5th. If I post this video at 4 o'clock, then you guys will not be able to invest and get that payout for May 1st. Again, if you so wish to do so. Not that I'm condoning buying a company solely for its dividend. And of course, they do pay their dividends quarterly. Now, coming back over here, we can see that based off of the current shares outstanding and this $1.80 in annual dividends, they pay out $304.56 million. So now let's jump into the fundamentals, starting of course with the net income. Oh boy. Well, I mean, we saw the PE being NA, so this is where this comes from, guys. We got 5 years ago of $1.64 billion to today of negative $2.23 billion. That is a lot of negatives, and it's very, very close to what it's very, very close to today. Obviously, it was just 1 year ago, i.e. 2022. So this is very concerning because this is a decrease of 235.71%. Again, if this was over here, like on the 5 and 4 year ago value, I'd be like, it's a long time ago, you know, they're consistently increasing it, sure, why not? You could kind of give it away. I was like, okay, fluke. But the fact that it was this much, I mean, guys, take a look at this. 2 years ago, they did $1.41 billion. And then 1 year ago, negative 2.23. Yeah, definitely please do more research as to why this occurred, because this could be a major, major red flag. And again, with the whole things happening with the banks, this might be a big problem. Again, I don't know if the whole bank situation is what caused this. Nonetheless, though, please take a look at this at your own leisure. Now, this is, guys, I'm going to give this like a 5%. Mainly because it's way too close. Massive negative drop. Only reason why it's 5 is because, I mean, you know, they brought it up from 3 to 2 years ago. But that's about it. Like, this is technically a 0%. Looking now at the total revenue, this one actually isn't doing too bad. We can see a pretty good consistent increase from 16.4 billion to 18.8 billion, increase of 14%. They peaked at 2 years ago, and then from 2 to 1 year ago, they came down slightly, going from 19.23 to 18.8. Nonetheless, though, it's still fairly decent in my personal opinion. Pretty consistent one from 5 to 4 to 3 and even to 2. So I'm actually going to give this at around like, I would say like a 90%. I would say I actually consider it very, very decent for this kind of revenue growth. Looking now at the shares outstanding. Now this one caught me by surprise because I saw that net income and I was just like, oh no, this is gonna be awful. And then the revenue, you know, kind of caught me by surprise. But revenues are weird. Revenues always tend to go up. Shares outstanding though, I was expecting massive dilution. On the contrary, it's actually massive share buybacks from 5 years ago of 206 million shares to today of 169.2 million shares. That is a decrease, guys, in the 5 year of almost 18%. And from the previous year to the current year, this is looking at 2 years ago of 177.2 million to 169.2 million. This is a decrease of a little bit more than 4.5%. Guys, every single year they bought back shares. Like, not one time did they keep it the same or, you know, increase it slightly. So I'm actually going to give this, guys, you know, a 100%. This is actually really, really good for shares outstanding. Again, I was not expecting that with the net income being that bad. In the form of assets and liabilities. Now, this is going to come back up when we get to the valuations part, because remember, book value and tangible book value rely on assets minus liabilities and then divide that by the current shares outstanding. And you can see here from 5 to 3 years ago, pretty consistent increase, reaching their peak 3 years ago of almost 22.7 billion. And then 2 years ago, they came down to 20.3 billion. And then from 2 years ago to today, they went from 20.3 billion to $4.1 billion, guys. That is a massive, massive drop. Again, not in the negatives, but we did see, not exactly the same, but very, very similar to that of the net income, where the 1 year ago value just crashed. Didn't go into the negative though, good thing. Average total assets, it is $342.8 billion. Average liabilities, it is $328.64 billion. And doing this difference, we get $14 billion. I am actually going to give this a ding because unfortunately, this right here is very, very close to home, like to right now as to what recently happened. So I am really uncertain as to where this might head. So unfortunately, I'm going to have to give this like a 40%. Again, I just do not know what caused it for starters. And I highly suggest everybody to do their own due diligence as to why this occurred. Because we just saw the same thing twice now with the net income in this one. And now looking at the overall grades, guys, we give the net income of 5%, revenue 90%, shares outstanding of 100%, assets minus liabilities 40%, for an overall grade of 60%. The biggest problem here, guys, it is this net income as well as the assets minus the liabilities. 60% though, it's more of like they're just average, not even average. It's like a little bit less than average. They have problems, but honestly, I don't know what caused them their problems. So if the problems, or at least the reason, so if the reason as to why those problems occurred is understandable, then by all means this could be higher. But for me, for somebody who has not done any due diligence, not looked at any 10Ks or earnings report, for me it's a 60%. And now let's take a look at the valuations, looking at the book value per share. Again, this is taking the assets minus the liabilities and then dividing that by the current shares outstanding. And this is what I mean, that this right here, this assets minus the liabilities over here, this massive drop from $20.3 billion to 4.1 has caused this thing to fall drastically. You can see here their peak was 3 years ago at $118. Interesting. Right now they're $18.41. So that was a drop, guys, by a whopping, what, 10 times? Yeah, that's a lot. And you can see here that this is a decrease of 74% from the 5-year goal value. But based off of the book value, guys, per share, the company should be worth $18.41. And now looking at the tangible book value, again, this is removing anything that's non-tangible. We can see that as of 1 year ago / today, it should be worth around $11.42. That is a massive drop, guys, from their peak 3 years ago of $108.52. And now, of course, taking a look at the valuation, looking at now the price divided by current book value, we can see that this is estimated at 1.17, and the price divided by current tangible book value is 1.89. Anything above 1, guys, it is considered overvalued. At 1, it is at value, and under 1, it is undervalued. So according to this, based off of the book value, this is looking a little bit overpriced, but it may not be too bad, depending on the premium that you wish to pay for this company. However, taking a look at this in regards to the tangible one, it's a little bit overpriced, right? It really is overpriced by almost like 100% or something like that. So it really is something that, again, you guys should just make that determination for yourselves. This is why I give out all of these calculators for free, because this is not financial advice. Every investment is the present value of all future cash flow. And even though this one doesn't require any form of, assumptions to be made, please still have it. Please see the fundamentals of the companies that you want. Also use the weighted grades to tell you, okay, based off of this, I think this is this grade, or this and this and this, and then see where you land. You can even change the percentages based off of what you guys value the most, But at the end of the day, guys, it's not financial advice. Please have all of these calculators for free. All we're asking for in return for daily content, free calculators, the earnings report being placed, so when we do the earnings report, being placed in the description. It's just like, subscribe, comment. It really does help out with the algorithm on YouTube. Thank you so much for the 2,300 subscribers. Right now, I think we're up more than, I think right now we're at 23, 21 subscribers. That's absolutely insane, guys. Thank you so much. We really do appreciate it. I know Mike hasn't made any videos as of recently. He's busy with home stuff. So once he's done, I'm pretty sure he'll make a video explaining what happened, and it'll do a solid video for a lot of you guys that want companies to be done through technical analysis. So just bear with him. He's taking care of some home ownership stuff. So yeah, that's just that, guys. Again, the best way that you guys can help us, it is like, subscribe, comment. It really does help, and just word of mouth, share. And now taking a look at the dividends at the current price, putting in, guys, $5,725. That is a massive yield. 8% is huge. And doing this, guys, we get 265.18 shares, which is an annual dividend. $477.33. Guys, that's insane. That's insane. What? That's crazy. Like, I normally like to buy anything above like 300 for $5,725, but 407, almost $500 a year. That's insane. Imagine getting a bonus. Actually, not even a bonus. A permanent. I wouldn't say permanent, but an increase in your salary by $500 by not doing anything. That's awesome. So, I don't condone buying companies solely for the dividend. Please do your own due diligence. The key is to buy a nice cash flowing company that also pays out a big dividend, that's also at fair value, or better yet, undervalued. That's the key. This company, to me, the fundamentals just aren't there, but you do what you guys want with your money. I'm not here to tell you what to do. Nonetheless, though, that's a lot of dividends, man. That really is a lot of dividends. And now coming into the options chains, we can see that we got here expirations for April, May, July, October, January 2024, and January 2025. So I think this is a case that the closer they'll get to expiration, the more expirations we get. So it is what it is. Nonetheless, though, taking a look at the April 21st one, guys, we got the strikes for $20, $17.50, $15, and $12.50. The $20 puts, we could see that if we were to sell a put, we would get $65. $17.50 strike, we get $20. Looking at the calls, for a call of $22.50, you would get $45, and then for $25, you would get $5. Looking at the May ones now, we can see a lot more actually. Well, a put for $20 would be $155. That's insane. That's a lot. And the call for $22.50, this is a lot as well, $140. So again, these options premiums aren't that bad when it comes to this one. You also have a lot of volume, as I can see right here too. So this might be a pretty good one to sell some puts. Again, $20 isn't a lot. It's about $2,000 per 100 shares. It really isn't a lot. And if you really want this company, if you want to have this company, then by all means, this might be a pretty good one to sell puts in. All in all, thank you so much for the recommendation, Tony. In regards to this company, I personally think Jackson is better. I think they are in the same industry. Yeah, I just personally prefer Jackson. Nonetheless, though, it's still an interesting one. And the fact that they're located in PA, which is where I live, it's actually interesting to see. Anyways, guys, that pretty much is it for this video. Like, if you like, comment, subscribe. It really does help with the algorithm on YouTube. You guys can follow us on the New Tech sites. Link is in the description below. So with that said, peace out, and we'll see you all in the next stock analysis video.